thank you everyone for joining us today. I am joined by Anthony Vossenberg and Joe Dunford from Thrivent. I was going to take a little bit and introduce, but I think in looking at the time, I wanted to go ahead and get started right away. So we'll be talking about the traditional long-term care insurance plan with Thrivent.
Good morning, everybody. It's Anthony Vossenberg, and I appreciate you being on the line today. I'm joined today with my colleague here, Joe Dunford, who many of you will know is one of our internal wholesalers. I'm responsible for leading the sale of long-term care insurance at Thrivent, and I'm absolutely delighted to be with you. So thank you, Lynn, for the invitation. Thank you, GoldenCare, for all the great work that you do and for bringing such a strong portfolio of solutions to your agents, which obviously includes a whole array of products like short-term care, traditional long-term care, linked benefit, or sometimes referred to as asset-based contracts. We are so lucky as agents to have so many choices, so many solutions to fit the individual needs of our client. I'm very excited and bullish about the long-term care business today. So with that being said, here's what we want to do today. I want to take a few minutes to talk a little bit about Thrivent, give you an overview of our company, I'll give you a high-level overview of our product offering, and then we're going to talk about some of the things that are really helping our agents work with their clients. We have been really enjoying a highly successful last 5-6 years. Our sales continue to grow year after year. We had a strong year last year, largely because of the help we received from firms like GoldenCare. We're up 30% this year. I think the market's up. We're seeing the interest in long-term care. In my view, I've been in this side of the business for 15 years. I think it's a better environment today than it has been certainly in the last 15 years. So I'm very bullish about the market. I'll try to extenuate why, or express rather why I feel that way as we go through our presentation this morning. So again, thanks for being on the line. For those of you who may not know Thrivent, we've been around for about 120 years. We are a not-for-profit. We are the nation's largest fraternal insurer. Our members or our policyholders become members. We are a member-owned company. Members do receive benefits, member benefits. We don't have time to get into that today, but that could be a great discussion in the future. Or if you want to learn about member benefits, just reach out to Joe or myself. Thrivent is a AA rated company. We have a Comdex score of 100. It's the highest you can have in the industry. We have $200 billion of assets under management. We have a common bond, that being Christianity. For those of you who don't know what that means, it means that our clients have to attest to being Christian to purchase insurance products from us. Sometimes I get asked this question: do I have to be Christian by my own definition of Christianity in order to work or sell Thrivent products? The answer is no, but you do need to attest to being Christian at the time of application or being married to somebody who is a Christian. So sometimes we see two spouses, one might be Christian, one might be could be Muslim, could be Jewish, but they're both able to acquire coverage from us. But something for you to be aware of. And for those of you who might wonder how to best position our unique value proposition, certainly feel comfortable to reach out to GoldenCare. They have a wonderful document called Thrivent 101, and it really nicely positions Thrivent's unique value proposition. So I just want to talk for a minute about claims. We've been around for 120 years. We've been in the long-term care business for about 40 years. And today we have 6,735 people on claim. That's specifically long-term care. We're paying $25,725,000 a month. So over $25 million a month in long-term care benefits. We insure over $3 billion in coverage. We've paid well over $300 million in claims. And for those of you who may not know this, you will probably know with traditional insurance products, the premiums are not guaranteed. And we've seen historically some level of in-force rate action, more so on older blocks of business. Thrivent, as I said, 40 years in the business. We have had one in-force rate action in the 40 years we've been in the business, and that was over 20 years ago, back in the time where our company was actually known as Aid Association of Lutherans and Lutheran Brotherhood. Those two Fortune 500 companies merged to become what we now know as Thrivent. And that was many years ago. We've never had a in-force rate action on Thrivent paper, and we're very proud of our rate stability story. So I share that with you. That being said, when we market our traditional long-term care insurance products, they do come with a 5-year rate guarantee. Well, that's not the length of the contract, but it's meaningful particularly for clients who choose to pay their premium over a 10-year duration. Because truthfully, we rarely see claims in the first year of a contract. Said another way, it's highly unlikely we'd ever see an in-force rate action in the first 10 years of a contract anyway. So just a little bit high level overview of our product, and then I'm going to talk to you a little bit about what's working. Our product is traditional long-term care. We issue coverage on clients that are as young as 18. Don't see a lot of those, not surprising. 18 all the way up to age 79. I would say that the core age band for marketing traditional long-term care and long-term care in general is probably ages 45 to 65. We know when people get older, they tend to experience chronic illness, and their likelihood of being able to qualify for coverage certainly goes down as they age. So we try to get to people before they are 60, certainly before 65, but we can insure up to age 79 if the client is in good health. 1,500 is our minimum monthly benefit, but we'll go up to 15,000. I would tell you that our average monthly benefit that we issue is probably around 4,800 a month in benefit. So that's typically about the average. With a 2 to 8 year benefit period. So with shared care, you could actually get 16 years of coverage. So that's about as good as it gets in the industry. We offer a reimbursement product, but we have the most attractive cash benefit rider that gives the client some level of indemnity, and we'll talk a little bit about that today and how that works. And inflation is offered in a 1, 2, 3, and 5 year option. But we also have a unique option called the flexible increased benefit. I'm going to talk a little bit about it today. This is an alternative way to structure an inflation rider that is particularly attractive to self-employed and business owners. So for those of you who work in that space, either exclusively or from time to time, I want you to understand how this rider works, because it will give you something unique to talk about, which is very attractive to the business owner market. And I mentioned all pay and 10 pay. So let's get right into sort of setting the stage for what we're going to cover today. I'll walk through maybe about 30 minutes of content, and then we'll try to leave a little time for Q&A, because your input and your questions are important to us. So with that said, if we can go on to the next slide, which will be a financial house, if you will. I will walk this group through a little bit of our philosophy. If we could move this forward, please. Thank you very much. Okay, so for those of you who are looking at your a monitor and seeing this slide, this is a little bit about how Thrivent goes to market and sets the stage for what we like to refer to as extended care planning. So first and foremost, we believe that long-term care planning is in fact an element, a very important component of retirement income planning. I would go as far as saying that no retirement plan is complete in the absence of an extended care plan. The biggest blind spots Americans have going into retirement is that they have, in most cases, not addressed long-term care, which, by the way, is the biggest by far derailer of a retirement income plan. So when we talk about helping clients build a financial plan, a financial house, we know that we need to have a strong foundation. And as people are, kind of going through their working years, their goal is to create cash flow and wealth. But at some point in time later in life, when they go from earned income to some form of what I would say investment and or pension income, what they are typically living on is a fixed income, but they're not living on fixed expenses. And if we don't factor in the cost of healthcare during retirement and the anticipated increased costs in healthcare in the event of a major event, whether due to physical or cognitive impairments, we typically find that the result of that is catastrophic, financially, emotionally, physically. And hopefully, if there's some money left over, people are able to fulfill their gifting and legacy goals. But we often say to our advisors and agents that we work with, the two biggest jobs of a financial planner or advisor is to help people create cash flow and to protect cash flow. Very often, financial advisors don't address the risk mitigation factors like extended care. And that's why you folks are so critically important to helping people fulfill their overall retirement plan. So let's go on here if we can. And I'm just going to highlight a concept for you. And this is something we talk to our clients about regularly. If you think about how to position extended care, this is just one way of doing it. It's the way that I usually talk to clients about it. When you're going into retirement, there is typically four main things to look at. So I want you to imagine this, or even draw a box on a piece of paper and divide that box into four quadrants. And what I will say to clients is, look, when you're going into retirement and factoring into the equation, what are the issues you need to take into consideration? I would say one is taxes, two is inflation, three is market volatility, and the fourth one is missed by most people, and that is healthcare, including extended care coverage. The fourth one, which is missed most of the time, is the most important and the most likely going to derail your retirement income plan. And that's why it's so important for us to have a conversation with you about extended care planning. Let's move on, please. Okay, so I'm going to bridge into a discussion. I've covered the product at a glance, and one of the things that I would say, and I try to highlight some of our competitive advantages, we've seen a great level of utilization of our cash benefit rider. I know there's a lot of discussion in the marketplace between reimbursement products and indemnity products. We kind of have a product that does that is more heavily weighted towards reimbursement. So said in other ways, clients have to have a extended care plan developed and in place, and as they incur expenses upon approval of a claim, they submit their expenses, and we reimburse them for those expenses. But we have a cash benefit rider, and the way that rider works, if you will, is we provide the client with cash, which is based on this formula. If they receive home care, 15% of their benefit will be paid in cash. And if they're in facility care, 10% of their benefit will be paid in cash. And our typical structure, or what we would call our base plan, is we recommend typically $4,500 a month. And the reason we say $4,500 a month is because we found from all of our research that the average clients on average are comfortable with about $200 a month of premium. Now, some pay more, some pay less, of course. But in order to get what we believe is meaningful baseline coverage, we want to be in the $4,500 to $4,500 to $5,000 a month of benefit. Now, some of this comes from this train of thought. We believe that the concept of co-insurance is a logical strategy to building a plan. What I mean by co-insurance is that the client takes some of the risk on and they defer most of the risk to an insurance company, because we know that the most viable way, the most economically viable way to fund a long-term care plan is through insurance. What we typically recommend is this. Most people want home care. The average cost of home care per month across the country is about $6,600 a month. We recommend that you cover 30% of the risk on your own and transfer 70% of the risk to the insurance company. And what that does, that means that the client is going to pay about $1,500 a month, and the insurance would cover another $4,500 a month. And that would cover home care. Now, if the client is buying coverage, around age 60, and we know the average claim age is 84, we can build with a 3% inflation factor. That coverage can grow because we want to make sure that by the time they get in their 80s, that $4,500 a month plan now has a benefit pool that would provide $10,000 to $12,000 a month of income to keep in pace with inflation and meet that 70-30% ratio. So what we recommend, instead of buying $4,500 a month of coverage, we would recommend buying $4,000 a month of base coverage and buying the cash benefit rider. That would provide the client with an additional $600 in the event of a claim whereby they were receiving home care, and it would be $400 if they were in facility care. So let's go to the next slide, and I'm going to show you how this plays out, and I'm going to show you how this compares, if you will, to working with compared to working with our competitors, National Guardian Life and Mutual of Omaha. So I'm going to use the example that we have a person age 60. He's buying $4,500 a month, standard health, and show you how this works. So what I want you to see is this grid that shows here how we would position this. So I'm just going to highlight a couple things in this screen, but down the middle would show the $4,500 a month. On the right side of the screen, you would see $4,000 a month plus the cash benefit rider would actually provide an extra $100 a month in benefit. What's interesting is that if you go down towards the bottom of the slide, you will see here that at age 85, that same plan, if they bought $4,500 a month, would grow to $10,000, almost $11,000 a month in benefit. And if they had bought it with the cash benefit rider, the actual benefits would be slightly higher, and the cost to the client is less than $10 a month. And this is for both a husband at age 60 and a female at age 55. They can buy coverage for about $10 a month of additional premium and be able to get 15% of the benefit in the form of cash, which we believe is a fantastic trade-off. So if the client gets into a claim situation and they want to pay somebody to walk their dog, they've got cash. If anything they want to have complete control without any receipts or reimbursement, it gives them some indemnity, and we think the combination of that is very attractive. So we recommend, if you're selling Thrivent, really look at this benefit rider. And now what I'd like to do is go to the next slide, Joe, and I'm going to show that in comparison, if you will, to our two market competitors, also very fine companies. So when you look at our product against Mutual of Omaha, they do have a cash benefit rider, folks. Many of you will know this. The way that they go to market with their cash benefit rider is it's automatically included in the contract. But at the time of claim, the client needs to make a decision. Do they want one of two things? Either to accept or elect, better said, the cash benefit rider, which would give them access to 25% of their core benefit pool. So if they had bought a plan initially of $4,500 a month, right? they would be able to access $1,250 at claim time if they want it in the form of cash. If they want to get their full benefit in terms of reimbursement, they would have to defer or not elect cash benefit rider, and they could receive the full $4,500 a month. It's one or the other. National Guardian Life doesn't offer cash benefit rider. Thrivent does. But in our case, it's not one or the other, it's both. You get the base plan and you get the cash benefit, and you get the cash benefit rider at a small premium. As I said, about $10 a month. It's going to give them the additional cash availability. So I wanted to make sure that you're aware of this rider. I want to encourage you to look at it. And with that in mind, let's move on, because I want to talk a little bit more about our flexible income benefit rider. So Joe, if you can move to that slide, that would be terrific. Now, all of you will know that healthcare is an expense that is going up every year. And when people talk about inflation, they talk about inflation as one general category. But the truth of the matter is, depending on what you're looking at, the inflation rate could be lower or higher than the national average. Healthcare tends to increase at a rate higher than the national average for inflation. And what we know and believe is that 5% inflation is probably the right number to add on to the plan, but it increases the cost of coverage in a way that, depending on the age of the client, you really need to evaluate is 2 or 3 or 5% the better route to go. Personally, I like for younger clients to buy 5%, and I'd rather have them buy a little less coverage and have that coverage grow at 5% to create a meaningful pool down the road. Older clients, I tend not to put as much emphasis on inflation, but I like inflation on all contracts. Now, dealing with the business owner, we have an alternative to the standard approach of inflation, and it's called the FIB rider. And I want to explain to you how it works. Joe, I'm going to actually ask you to go to the graph for us, because this will allow me to explain to this group how this works. Now, my experiences, and having been a previous business owner, I would say that for most business owners or self-employed, they do not have the same level of predictability around their income, their revenue, and sometimes expenses. And this would be a great market. People are finding running businesses today, for a whole bunch of reasons, expenses are very difficult to control right now. Some of that might have to do with tariffs. Some of it has to do with the implications of the oil-related challenges that we find ourselves in today. And businesses are having to rethink how they go to market. Well, if you're a business owner looking at the proposition of buying insurance coverage, one of the factors might be, every year with this product, if I buy standard 5%, I'm going to pay much more premium upfront for that plan. What if we could give them an alternative? What if we could say to the business owner, we're going to give you a 5% increase every year, but you have the choice to decline it. If this is a year, or next year is a year that you think maybe cash flow is tighter and you would prefer not for your premiums not to go up on your policy, then you can deny that increase. So when you start the contract, it's much less expensive because you're not paying the 5% up front. You're making that decision year by year by year. Now, here's the beautiful thing. The client has complete control. We're going to offer the 5%. They have the option to decline it. But if you look at this illustration, we have a client who's 50 years of age. They bought about $5,500 a month. And you can tell by the bars in this graph that the coverage or benefit pool is going up every year. The blue bar around, I think at age 58, the client says, no, thanks, I'm going to deny the 5% increase. And then it's offered again the following year. And the blue bars will show you that over the next 20 years of that client's life, they have many years where they've decided not to take the benefit. If they deny the claim, or pardon me, deny the benefit increase 3 years in a row, they lose the benefit. Now, in some cases, a client will say, I'm doing that intentionally because I may build up the benefit base so dramatically, like in this case at age 75, actually in age 72, 73, the client has 15,000 a monthly benefit and says, I don't really want more coverage. So I'm just going to stop. I'm going to stop accepting the 5%. So for the next, I don't know, next 10, 12, 15 years, the client has got a level flat premium and they go on claim. When the client goes on claim, we will automatically restart the 5% increase. So their benefit pool will continue to go up every single year without them paying additional premium. They'll be on waiver and they won't be paying for the base plan, nor will they be paying for the additional 5% increase every year. That is a beautiful benefit. And on top of that, you guys will know that business owners typically can deduct premium, and most of our clients can deduct a certain amount of their premium based on the tax laws, which we may have a chance to get into today. So the flexible increase benefit is really designed to give client control of how they and give you control on how you design inflation, give the clients design control of how premium is paid, and give, I would say, business owners who have a little less predictability in income control over how they manage their long-term care premiums. This is unique to our company. It's not used on every contract by any means, but it's something for you to be aware of. All right, Joe, I think we've covered that. And let's just go on to the business owner deductions, if we could, please. I made reference to that a second ago. Joe, can you confirm that that's on the screen?
Yes. Yeah.
Okay, so what I want to do here is for those of you that may not be as familiar with deductions that are available, let me just kind of walk you through a very simple example. And I'm not going to go through all of these lines or numbers, but I'm going to pretend we sold a policy back in 2015. So if you look at the far left, you can see in 2015, we insured somebody that was age 53. And in this case, the client bought $5,000 a month, 3-year benefit period with an elimination period of 90 days. The premium on this contract is $1,414 a year. But the client at this income level, this client is at a 25% tax rate, which we used as our assumption. And they are allowed to deduct up to $1,430 of their premium. Now they're paying $1,414, not the full eligible deduction. So if you take the premium $1,414 and you multiply that by the 25% tax deduction, their net premium becomes $1,000 and $1,061, right? The premium on the contract's $1,414, but because of the tax deduction, they're only paying $1,061 in premium. So as these deductions increase year after year, let's take this client to say year 2020. They're now age 58. Okay. Now, at that point, if they were age at that point in time, Joe, you can see here their premium for somebody at that age is $1,688. The deduction at that age is $1,690. Their net premium is $1,266. So what's really important for you to understand is when you're talking to the business owner and understanding the tax laws in any given state, most of us have the ability to deduct or claim up to a certain amount of money towards premium. So every year when I file my tax return, I advise my CPA how much money I pay in long-term care premium. And I would say probably 60% or so of my premium is deductible. If you're not familiar with the tax laws that relate to long-term care, I would say get familiar, call our team, but understand that we need to talk more to our clients about the opportunity to reduce their net premium by taking full advantage of the Tax Act. Okay, so if that is very particularly of interest to business owners, but I would say relevant to all of your clients. All right, Joe, let's move on. And we're almost at time. And I want to, Lynn, I want to make sure that we are able to take some questions from our audience. Would you like to do that now?
Um, I know that, or I should have mentioned earlier that questions can be typed into the
Okay.
questions box at any point. There had been a couple about requesting copies of the slides, and I did mention that I would ask, but ultimately that is up to Thrivent.
Yes. So that's it. Well, thank you for that question. I can't release this presentation, but what I can do is I can give you marketing collateral that will speak to most of this stuff, and we'll do that for you.
Perfect.
Was there a second question, Lynn?
Actually, there was just multiple people asking for slides.
Okay, no problem. So let me maybe end on this note here. One of the things I'd like to remind people of is that we do have an all pay and we have a 10 pay. And my point of view is that the 10 pay does not get leveraged nearly enough. And I want to share a point of view. It's a financial planning concept that I have found very, very effective in working with clients. So I've been in the business now for a little over 4 decades. And what I have never met a client that has said to me, I'm okay with, I like paying, I want to pay premiums for insurance contracts after my earned income has stopped. So what I really try hard to do with as many clients as possible is help them pay off, pay for, get to the point where when they retire, they can retire the premiums on their life insurance, on their long-term care insurance. How do we do that? We market to them a 10 pay solution. If they have the financial means to pay the premium affiliated with a 10 pay, particularly on a traditional insurance product, I would highly encourage you to make that an option to your client. Why? One, clients generally don't want to pay for long-term care premiums for the rest of their lives. So if we can get to clients earlier in our philosophy is we start doing long-term care planning with our clients no later than age 50. So if they're 50 and they say to me that they're going to retire or their plan is to retire at 60 or any point thereafter, I will often ask them, would they like to be in a position where they have the ability to stop paying premiums on their long-term care policy at about the time they retire? And for many of the people that we're working with, the timing works out pretty darn good. So if they have the financial means to pay over 10 years, I would really encourage you to at least give them the option to do so. And you will find the other benefit that goes with that is you almost eliminate the potential for an in-force rate action. How? Well, we offer a 5-year rate guarantee. In the next 5 years, while I can't guarantee it, the likelihood of that client having an in-force rate action is very, very small. Why? We have virtually no claims in the first 10 years of the business. So generally speaking, it's not a risk the insurance company deems as particularly pertinent or big. So that's just a concept I want you to think about. And you will find for those clients that can do 10 pay, it positions them a little bit more favorably at the time when their earned income stops and they move into retirement. So that is I'm going to conclude with that. Unless we had a couple more minutes, we can show you a price comparison between the traditional insurance companies. Lynn, do we have a couple more minutes?
We do. We can certainly do a couple more minutes.
Okay, so Joe, would you please walk through the heat maps for us?
Sure. Yeah. The heat map just kind of came out a couple weeks ago. We revised it, and we have it showing here with a married male, a married female, and then combining both premiums, and $4,500 a month benefit for 3 years, 3% compound inflation, 90-day elimination period, including the waiver of home care elimination period rider, which is pretty inexpensive with Thrivent, and at Standard Health. And of course, when a male married applies solo or a female applies solo, they get the partial 5% discount. If they both apply and get an offer, then Thrivent has the 20% full spouse discount. Mutual of Omaha's is 15%, just FYI. So these are the ICC states, most of the states showing here first, and then California and Florida. And this is just showing Thrivent and Mutual of Omaha. And you'll see Thrivent is very competitive in their pricing. They stack up well in these instances with Mutual of Omaha, and it does quite well. And Thrivent hasn't had a rate increase in over 20 years. Mutuals had gone 10 years without a rate increase, but some of the states last year, and then some more states this year, are going to be getting their chance to raise their rates. Like here in Minnesota, they just announced last week they're going to do a rate increase here, and another state as well. So we like Thrivent for that. I think they don't have any design of raising rates, and they're especially the best thing in town, basically in Florida and California. And you can see on this slide that the rates also include National Guardian Life and their original plan that they still have in Florida and California, the new Honest plan, not out there yet. So you'll see Thrivent super competitive, in Florida and California, and and that's pretty much due to our nationwide pricing, while the other carriers have more state-specific type pricing. And so, yeah, California's higher priced, Florida's higher priced, so companies kind of adjusted those and so on and so forth. But ours is still the kind of the original pricing, if you will. And so we're coming in kind of the best plan anybody can have in California and Florida. So if you do business in those states, have some people living there you can help, it's fantastic. The difference is really huge, as you can see. So those two states are fantastic. And then again, going back to the original slide here, and this is for a 50-year-old and a 45-year-old female. And then it shows every 5-year increments, 55 and 50, 60 and 55, and 65 and 60. So those all look very good. So Thrivent's doing well with the pricing. We think the pricing is hard to beat. Some of the Honest LTC that NGL came out with about 3 to 4 weeks ago, they've adjusted their plan somewhat, brought their premiums down a little bit, and we're still certainly right with them, and oftentimes still a little bit better. So the Thrivent pricing is where you're going to like it.
Thank you, Joe. Lynn, have there been any additional questions presented?
I have not seen any additional questions submitted through the chat, but I did want to tack on to what Joe was saying. In my own experience, even recently comparing, we offer a StratDecision tool where we can actually do pricing and feature comparisons between, of course, the three big ones. Joe, you did name them: Thrivent, of course, Mutual of Omaha, and then the new Honest LTC plan with NGL. And Thrivent has been really, really competitive. With the new pricing that NGL has, it is pretty close.
Yes.
But overall, the strength of the financials that Thrivent offers, there's no competition there, in my opinion.
Yeah, and one other thing too with the NGL product, they don't have like the cash benefit rider, and they have kind of the one level of offer. You basically either get an offer or you don't. Thrivent, of course, has a preferred level, standard level, class 1, class 2. So if people have some health issues going on, they might be able to get an offer with Thrivent that they may not get with NGL, just depending upon what it is. So a little bit restricting themselves on just the one class offering versus the 4 that Thrivent has.
That's
Right.
great. So let me just say this, if I could, in closing. First of all, thank you very much for being with us. And I started by saying one of the things that's beautiful about our industry is that it appears that the awareness factor in, I think, client or consumer interest in long-term care is growing. We have an accountability, I think, as agents to raise the topic. That meaning, all too often, our sales opportunities are initiated by the client. And in many cases, clients who are not in good health and often older. I think if we take charge and proactively reach out to our friends, family, and clients, that our opportunities are better. And quite frankly, we open up a conversation that needs to happen. Not always a conversation people want to have, but they need to have it. So we appreciate the work that you do. You have a wonderful product platform offered to you through GoldenCare that allows you to meet a very wide set of needs across various client profiles. They do a great job. We're very pleased to be partners with GoldenCare. If you have questions, reach out to the sales desk at GoldenCare, and certainly we're available to work and help you and our friends at GoldenCare whenever you need that help. So thank you for considering Thrivent. We appreciate your business. Have a wonderful year, and we look forward to talking to you again. Have a great day.
Thank you both for your
Thanks,
time, and
everybody.
thanks everyone for joining us today.
Yeah,
Take
appreciate
care.
the time. You bet.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.